Farming for the market is a business. It is a business in that farmers use land, labor, and capital for the produce of goods to be sold. Such farming is done in the hope and expectation of profit as are all other businesses. A business-minded farming keeps proper records during the venture. A farm record is a document, in most cases a book, that is used to keep account of different activities, events, materials etc. regarding the farm operations. Farm records are different from farm accounts in the sense that farm accounts deal only with the financial aspects of all farm operations. Farm accounts deal majorly with the farm expenditures and income and help the farmer to calculate how his business is doing. Most African farmers don't keep farm records and accounts, so they have poor farm management. Mainly it is influenced by the fact that most of the farmers in Africa are illiterates and can hardly read or write. Farming is a business and good farm record keeping helps the farmer plan and do realistic forecasting. Record keeping provides valuable information on which methods work. The farmer can better predict price changes of inputs and produce from expenditures and sales records kept from previous years. In summary, you need good records to monitor the progress of your business. Records can show whether your business is improving, which items are selling, or what changes you need to make. Good records can increase the likelihood of business success. Here is a list of many reasons why farm record keeping is encouraged. Recognize a problem when it arises and search for its root causes. Observe the relevant facts and gather the relevant data to solve the problem. Analyze the data with specific objectives in mind, guided by the principles, the tools and the mathematical models applicable to the problem. Select the appropriate course of action to solve the problem and achieve goals and objectives. Report and document income taxes. Make management decisions. Check whether the business is operating according to plans. Obtain credit. Determine whether the farm can compete with other similar farms. Farm records can also be used as a basis to request for a loan. Ensure a farm obtain government subsidies or grants. Prepare income tax returns. The records of sales and expenses are combined with those of inventory changes to prepare the farm accounting statements at the end of a year of operations. Accurate records help the manager to recognize and avoid losses. The farm records provide basic profit and loss statement and position statements called the balance sheet. Input-output relationships for determining technical efficiency and selecting appropriate enterprises. Inventory of available physical and financial resources. Performance indicators in the form of efficiency ratios. And many more. Think of it, one of the most important indicators of financial progress of a farm business or of an individual is the balance sheet, sometimes called the net worth statement or a financial statement. The balance sheet is a listing on a particular date, of all the assets and their value, all the liabilities and the difference between assets and liabilities, which is the net worth. Assets and liabilities are listed according to whether they are current, intermediate or long-term. Current assets are cash and other resources that are expected to be realized in cash, sold, or used up within 1 year. Current liabilities are debts expected to be paid back within 1 to 10 years, while intermediate assets are resources that are expected to last from 1 to 10 years. Long-term assets and liabilities are those that last more than 10 years. Current assets are usually valued at market value or cost of production. Finished product inventory should be valued at sale or market value minus marketing costs. Products in process, growing wheat, cattle rearing etc., should be valued at either cost of production as of the date of the inventory or at market value if there is a competitive market for such products. A series of balance sheets over time will show trends in the financial worth of a business or an individual. On farms where one individual or family is involved, the business and personal balance sheets are often the same. When businesses are owned or operated by several persons, the business and each person may have separated balance sheets. Receipts are a document that represents proof of a financial transaction. Receipts are issued in business-to-business dealings as well as stock market transactions. Receipts are also necessary for tax purposes as proof of certain expenses. Receipt types: sales invoice, purchase invoice, travel invoice, expense invoice, journal, salary, VAT summary, tax return for self-assessed taxes. Capital receipts are receipts that create liabilities or reduce financial assets. They also refer to incoming cash flows. Capital receipts can be both non-debt and debt receipts. Some common expense accounts are cost of sales, utilities expense, discount allowed, cleaning expense, depreciation expense, delivery expense, income tax expense, insurance expense, interest expense, advertising expense, promotion expense, repairs expense, maintenance expense, rent expense, salaries and wages expense. Capital account is your investment in the partnership. The capital account starts with the initial investment and increases through contributions or cash, or property and allocations of profits. It decreases due to distributions and share of losses. Assets are items owned by the farm business that have value. Liabilities include outstanding financial obligations for farm operating expenses such as feed, seed, and fuel. Other liabilities may also include loans for market or breeding livestock, machinery, equipment, land, buildings, and improvements. Look at your farm and list the assets and liabilities you have. Records sales made on the credit and purchases made on credit. The manager has to balance credit sales and purchases against cash transactions. Money has a cost and it is not wise to allow people to hold onto your funds for too long. By the same token, one should not accumulate large amounts of payables or debts.